there is, as I see it, a kind of big gap between how policymakers and how academics treated this idea of financial inclusion, which is broadly the participation of citizens and consumers within financial markets. A lot of the policymakers were interested in examining something which can be called kind of poverty premium, the idea of lack of access, the sort of costs associated with lack of access to the financial system. So, for example, not being able to access mainstream financial credit. So you go to a doorstep lender, for example, not having enough savings, and the sort of costs that imposes on people. Lack of a bank account means that I can't, for example, use direct debit to have cheap fuel deals, which can contribute to fuel poverty and so on. But on the other hand, a lot of the academic literature is quite critical of this agenda, which is the idea that it's basically undermining the collective provision of services, i.e. the welfare state, and it's kind of throwing people onto the whim of financial markets. And so part of my issue with writing the book was to try to look at the insights from both of these different literatures and try to bring them together. There's different ways we can look at how people are excluded from the financial system. Now here, I'm looking at the UK specifically. Now, there are a variety of different ways of measuring the stats. The University of Birmingham actually has done a series of financial inclusion monitoring reports, which provide us an annual snapshot. I think they've done it for the past 8 to 10 years, which gives you a kind of snapshot of some of the key findings. Here's some data also from the Financial Inclusion Commission, of which Jean Williams is vice chair. So, for example, it records that about 12.5 million UK adults have little or no confidence to manage money. 1 million adults don't have a bank account. About a fifth of adults have less than £100 in savings. And over a quarter of adults now have faced some form of drop of income due to COVID-19. Now, why does this matter? Well, pre-COVID, for example, the fact you've only got £100 in savings, for example, means that you don't have much of a financial cushion in case something goes wrong. And it doesn't have to be something massive. It could be like the washing machine breaking down. And then it can run into problems. Now, because then people might have to borrow, they might not have easy access to borrowing, they might then start paying prohibitive rates of interest and so on. Now, so these are why the different aspects of financial not being included within the financial system matter. And it goes without saying that we've all seen there've been drops of income, particularly due to COVID-19. And these have also been concentrated at specific parts of the population. So those workers, for example, who've been furloughed, who've been unable, who've been unable to work at home, and so on. In some cases, I've faced a very uneven. COVID has had a very uneven impact. What do we mean by financial inclusion? And a common starting point is the idea that it's the kind of access that people have to financial services. And the financial services, we're talking about things such as banking, saving, insurance, and credit. It's often likened to being connected to the electricity mains. So, for example, the Financial Inclusion Commission talks about financial inclusion is like being connected to the electric grid. Similarly, in John Montgomery's book on household debt, I think she uses the kind of metaphor of an irrigation system. But this kind of access point means that what access do I have as a consumer or as a citizen to accessing banks? And this often leads to what is sometimes called the supply and demand concept of financial inclusion. So the demand side is me as a citizen trying to access the service. And also you've got a supply side where the actual financial institutions and so on. Why does that matter? Because some of the kind of policy things we want to talk about or want to discuss, well, are they is the challenge primarily a demand side one? So, for example, improving people's financial capability, their ability to make financial decisions, or is it that actually people are actually quite financially savvy, and the problem is that we need better regulation of the supply side? Another aspect in the kind of literature is that we need a kind of richer sense of what we mean by being included in the financial system. And this is the idea. We need to think about the kind of resources that people bring with them to the financial system. And here, work's been done within geography, originally within geography about different networks, and the kind of middle class networks or higher income networks have got a variety of different sort of resources that they can bring with them to help them navigate the challenges of the financial system. One of the key claims I make in the book is that actually it's treated very differently by mainstream academics and also by policymakers. Now, this admittedly is an oversimplification. There's plenty of academics who do both, who delve into the kind of policy world. Likewise, there's many people in the policy field who engage actively with academic debates. But nevertheless, what I was struck by when I was researching and actually attending meetings and so on was that financial inclusion is talked about quite differently with these different audiences, but both have got something useful to add to the debate. So as I said before, supporters of financial inclusion say that, look, being outside mainstream financial services imposes extra costs on the individual. So this is the idea of a poverty premium. I can't get direct debits, for example, to pay for cheaper fuel deals. That means that I have to bear extra costs. I can't have mainstream borrowing, so that means I have to turn to a doorstep lender and so on. And these have real impacts on very vulnerable parts of society and community. The critics say that, well, look, what they're concerned at is that ultimately financial inclusion is about making individuals make much more financial decisions within the financial market. But in doing so, that the critics allege, or some critics allege, that it also involves people rolling back the welfare state, the idea of collective supply and provision. Now, this critique of financial inclusion is part of a much wider academic critique of what's called financialization. But the key point here is that we have something that has a direct bearing on people's lives that is treated very differently by two very important communities, the kind of scholarly community and the policy community. What I'm trying to do in the book is to say, right, look, we can try to gain insights from both literatures. It'd be good if both can talk to each other, so academics can engage, for example, with the policy field and look at the different sort of choices. Likewise, policy makers, it'd be useful to delve into these critical academic literature. My starting point here is, as I progress through the book, is that, look, making financial decisions is part of everyday life. And so we all, in whatever system we live in, we need to pay bills, pay rent, and so on. And so actually, it's an everyday life of finance. So rather than reject the idea of financial inclusion entirely, the real question is, well, what different models, what different versions can we create? And so rather than jettison financial inclusion, the idea is, well, what different type do we want? And here we can be creative. Now, so as part of this in the book, I talk about savings. I look at examples such as savings, long-term savings. I look at things like auto-enrollment of pensions, also housing, I cover in the book. But in thinking about different alternatives, now we're that's the kind of next stage of the debate. And some of the topics I cover some possible different ways of looking at the ways in financial inclusion might be able to support different versions. So, for example, one policy idea that has attracted interest is the idea of a universal basic income, the idea that all citizens get a regular income payment from government without any work obligation. Now, whatever your take on a universal basic income, it relies on an infrastructure of kind of accounts, because any payment of a regular any income payment needs to be paid into a bank account. So this is where the idea of the infrastructure is important, in the sense that whatever criticisms we might have of existing models of financial inclusions, it's an unavoidable part of life. So here we go back to the idea of infrastructure.